Look, on the surface, this story seems ridiculously simple. A cybersecurity company has a great quarter, the market absolutely cheers, and everyone just assumes it's a guaranteed win. But in this explainer, we're going to systematically unpack the central mystery behind Okta's seemingly obvious stock surge. Because, investors have made this exact mistake before. They see a strong quarter, they see a rising stock, and they automatically assume the investment is a no-brainer. But the market doesn't reward a company simply for making money. It rewards a company for making more money than expected for longer than expected without forcing you to pay way too much for that future. So what exactly changed at Okta? Are we just watching a simple earnings beat, or is this the beginning of a massive transformation? Let's get into it. We start our investigation with a completely jaw-dropping number, $805 million in just one single quarter. I mean, for any software company, knocking on the door of $1 billion quarter is a massive milestone, right? And what's absolutely crucial here is that almost all of this came directly from highly predictable recurring subscriptions. That $805 million represents a solid 11% growth over the previous year. Now, 11% is steady, it's reliable, but if we're being completely honest with ourselves, for a high-flying tech company operating in the red-hot cybersecurity space, it isn't exactly explosive. It's certainly not the 30 or 40% growth that usually grabs all the headlines. But then we look a little deeper and see a much, much larger number, a massive $4.858 billion just sitting there in their subscription backlog. Think of this like an enormous financial iceberg sitting just below the surface. This is contracted revenue that has already been signed, the ink is dry, but it just hasn't hit the income statement quite yet. And here is the kicker. That backlog is growing at an impressive 17%. So the business you see today above the water is growing at 11%, but the contractual backlog sitting underneath the surface, that's actually accelerating noticeably faster. So what did the market do? It reacted to these figures by pushing Okta's shares up a whopping 20%. On paper, these metrics seem to tell a super obvious story of accelerating cash generation and a fast-moving stock. But there is a glaring problem here. And here is the uncomfortable surprise that kicks off our real investigation. If this business is truly transforming, and if AI is supposed to be creating this massive new identity problem for them to solve, why is their future revenue guidance so stubbornly low? Seriously, why is management telling us to expect only 10 to 11% top-line growth? That's the first huge information gap we need to close. To solve this contradiction, we first got to understand exactly what they do. Okta sells recurring software subscriptions that secure digital identities for workforces, for customers, and increasingly for AI. Basically, their technology helps organizations determine exactly who a user is, what specific applications they can access, and what they're actually allowed to do once they get inside. But this business is evolving so rapidly. It's not just about Dave in accounting logging into his email anymore. We're talking about securing human identity, machine identity, and the completely wild new frontier of autonomous AI agents. The disconnect between today's reality and tomorrow's momentum is just stunning. Think about the steps here. Current revenue is chugging along at 11%, but the short-term backlog, the CRPO, is growing at 14%, and the total RPO is accelerating at 17%. It's like looking at a coiled spring. Now, just as a quick refresher for anyone newer to financial statements, RPO simply means contracted future business. It's hard, verifiable evidence that tomorrow's momentum is legitimately outpacing today's reality. And CRPO, that's just the portion of that contracted revenue expected to actually hit the books within the next 12 months. But the real question is, where is all this future demand actually coming from? Well, the real prize for Okta isn't just signing one single contract. No, it's about getting deeply embedded into an enterprise. This right here is the holy grail of software business models. You don't have to constantly hunt for brand new customers every single quarter. You land a contract, you get your technology deeply embedded into their ecosystem, and then you cross-sell identity controls for machines, for developers, and for AI. It's a massive expansion loop. So the absolutely crucial point we have to figure out is whether this whole explosion of artificial intelligence is going to create the next massive expansion layer for their sales team. Because let's be real, we've all heard these enormous world-changing AI stories before. The question isn't whether AI creates a security problem. We know it does. The real question is whether Okta can turn that specific problem into actual measurable revenue. Think about it like this. Autonomous AI agents need to be governed and authenticated exactly like human employees. If an AI agent is going to automatically retrieve highly sensitive client data from Salesforce just to draft a report, well,
Who monitors its behavior? Who actually pulls the plug if it goes rogue? Okta is claiming they're perfectly positioned to be that digital bouncer, but again, positioning is just a great story until it actually hits the income statement.
While we wait for that AI revenue to fully materialize, we're hit with a massive profitability surprise. Operating income literally skyrocketed 161%. They went from $41 million in GAAP operating income the previous year all the way to $107 million this current year. The operating margin more than doubled, jumping from 6% to 13%. So even without massive revenue acceleration right now, Okta is rapidly becoming a dramatically more profitable software company.
But as we know, accounting profit is definitely not the same as cold, hard cash. Which means we've got to look at free cash flow to see if this business is actually accumulating real wealth. Revenue and operating income can have a lot of accounting noise. Free cash flow strips all that away and tells us exactly how much actual cash the business deposited into the bank. And Okta generated a phenomenal $227 million in free cash flow. That represents a 40% jump and a highly lucrative 28% margin. Think about that for a second. For every single dollar of revenue that comes in the door, 28 cents drops straight to the bottom line as free cash flow. That is an incredibly strong number.
Now, this mountain of cash leads us to our next clue. Okta ended July with nearly $2.3 billion in cash and short-term investments, and they went ahead and used $372 million of that to buy back common stock during the quarter. But here's the catch. Sophisticated investors know you can't just cheer blindly every time you hear the words stock buyback. You have to ask the hard question. Is management genuinely returning capital to you, or are they just buying shares to cover up the dilution of paying their own employees in stock? And that brings us right back to that stubbornly low growth rate we talked about earlier. Even when we give them a total pass for a strategic shift to partners, which admittedly created about a 1% headwind, we are still staring at 10 to 11% growth for fiscal 2027. Management deliberately shifted some professional services work, sure, but that headline growth rate absolutely forces a vital question. A business can improve its margins, it can explode its cash flow, but the stock will still disappoint if investors simply pay way too high a valuation multiple for that future performance. This is what we call the classic expectations trap. If earnings grow by 15%, but the market valuation multiple falls by 30% because investors overpaid on day one, well, the business improved, but your stock portfolio still performed terribly.
So how does all this data shake out? It builds into three distinct futures for the stock, forcing us to separate the reality of a high-quality company from a potentially dangerous entry price. In case A, the big bull case, AI agent identity actually becomes meaningful revenue. RPO stays super high and the market justifies a premium valuation. In case B, the base case, revenue stays near that 10 to 13% mark, margins expand, and you basically get a quality business with a moderate stock return. But in case C, the expectations collapse, AI monetization disappoints, competition intensifies, the valuation multiple contracts, and the stock deeply disappoints even if the underlying business totally survives.
You see, sophisticated investors aren't just crossing their fingers and blindly hoping for case A. They are continuously measuring very specific risks. Okta loves to pride itself on being the independent, neutral player in the space, but the ultimate test is whether that independence is a massive advantage or a fatal flaw when you're going head-to-head with a vertically integrated giant like Microsoft, who desperately wants to own the entire security stack and compress Okta's pricing power. All right, we've finally made it to the ultimate scorecard. Taking all of our clues, from the glowing green cash flows all the way to the glaring orange threat of big tech competition, we can map out the entire investigation. Revenue size, RPO growth, GAAP operating margins, and free cash flow are all flashing a very, very healthy green. But as we look down the board, that FY27 top-line growth of 10 to 11%, that is a cautious yellow. The true AI opportunity is honestly still emerging, and the impact of Microsoft's competition remains a serious ongoing threat. So now we have to ask the multi-billion-dollar question. Based on everything we've uncovered today, what is the actual verdict for you? Because remember, an opportunity is not the same thing as a shareholder return. Okta has to turn their incredible AI positioning into actual revenue. Their margins must keep expanding, cash flow has to remain durable, and above all, the stock price has to leave investors enough upside from today's entry point. We'll leave the final rating locked for you to decide, but these are literally the only three numbers you need to track in the next earnings report to determine if the bull case is actually coming true. Number 1, can revenue growth finally break out above 11%? Number 2, can future demand, measured by that RPO, sustain its 17% growth? And number 3, can they maintain that highly lucrative free cash flow margin right near 28 or 29%? If Okta hits these three metrics, their AI transformation is completely real. If they fail, that expectations trap springs shut. So ask yourself, is Okta about to become the undisputed gatekeeper of the AI revolution, or are they just another cautionary tale of investors paying too much for tomorrow? Keep these numbers on your dashboard, and let's find out.